And we're live. YouTube. Noah here. We have a lot going on this planet, and I like to talk. I like to think about what's going on and what it means to you and me and the system. So, this topic that I wanted to start with was obviously something I cover quite often, legacy financial systems and what is being born with new DeFi systems, decentralized financial systems, with legacy financial systems being CeFi, centralized financial systems. So let's start with the legacy system and what is going on right now. Look at all the younger people piling into Robinhood and just figuring out what stocks are, because we finally have applications that facilitate the average Joe doing stock participation, investing, which means historically this was not the case. Historically, you had to sign up for a Fidelity account, Charles Schwab, or whatever it is in the respective nation where people are, and that is a process. Anytime there is a process to get involved with something, there is resistance, because you have to sign up for an account, you have to provide documentation, you have to link your bank account, you have to transfer funds, and that's intimidating because the vast majority of people see fiat, see their dollars as their point of reference. So if they're transferring money from a bank account to Fidelity, for instance, they no longer have that money. And that is a fallacy that I've discussed quite often, because they do. They're transferring value. If they transfer fiat into an asset, a stock, a bond, a treasury, crypto, you still have your value. Money doesn't matter. What matters is value. So we're seeing these barriers, these resistance barriers drop down. But the problem is that they're going to the wrong places. And this is not something that's going to end well. The general public getting involved with the stock market at 152% stock market size to GDP is a recipe for disaster. And it's unfortunate because of exactly the point that I wanted to make in this video and legacy financial systems. When transferring value from fiat into an asset and the asset increases in price, let's say it goes from $1 to $10, and you sell your $10 asset, you now have $10 one time. That's it. Stop chasing appreciating assets. That will not win. That will not do what everyone is looking to do, because if you spend that $10, it's gone. But if that $10 is producing 10% yield, and you keep adding to that $10, $100, $1,000, $10,000, now you have income. You have replaced your job. So that is what I like to see as the most important goal. I don't even call it investing anymore. I call it saving, because you cannot save fiat to get to anywhere near where you want to be. You have to save other types of assets, and hopefully the vast majority of those other assets are recurring revenue streams. So the legacy financial system has bonds, treasuries, REITs that produce yield. The search for yield, that is the holy grail of freedom, financial freedom. Now, clearly, the word freedom brings up the topic of physical freedom, which is a complexity unto itself. But financial freedom is an emotional and psychological burden that is devastating, that causes people to commit suicide if they are financially indebted and there is no path to relief or success. It's devastating, destructive, and that's a big problem with society. And I think this comes back to like education, and the education system should teach people financial management and what to do with value and how to generate returns and yield, because working and having no path to success is devastating and destructive. So, legacy financial systems, the search for yield. How do we do it? REITs, with regard to equities, bonds, and treasuries. What has happened with these percentages of APR, treasuries and bonds are zero. They're worthless. The general public, it's useless. And frankly, I think large scale entities find it useless as well. We find that pension funds in the United States are quickly rolling into more riskier assets to produce the yield required to pass on the benefits to their subscribers or contributors or whatever, however they classify those persons participating in pension funds. So riskier assets are assets where the value of the asset can decrease or increase volatility, and those are like REITs. So clearly a REIT is an equity, and equities are completely susceptible to the psychological shitstorm that's occurring on the markets, which have nothing to do with fundamentals. The actual profit, the income of these companies do not drive asset valuations. It is dead. Fundamental analysis is dead on the global stock markets. If you are an FA guy that appreciates fundamentals, how much a company is generating, how big is their business, how much are they spending, are they saving more than they're spending, like good stewards of asset value, it's useless. It's irrelevant. It means nothing. The price of a stock operates in what's called P&E. And the P&Es are multiples of their earnings, 10 to 1, 20 to 1, 30 to 1, which means it's inflated. A company, the stock price, you cannot, let's say a stock is $10, and next year they're expected to triple their revenue. The stock isn't going to go triple based on the fundamentals. It's going to go up 10 times or 20 times or whatever, and then drop down 50% because of a bad headline. Fundamental analysis is fundamentally dead, and that's disappointing. So I personally state and feel that investing in traditional asset classes it's too risky. There is no way to properly assess what you're getting involved with. It's a gamble. It is pure speculation and gambling. So I also like to think that crypto has become a great place for fundamental analysis, because we're talking about not the analysis of a company and their revenue and expenditures, but the assessment of the technology and what is the technology doing. And the fundamental analysis of crypto projects I like to reduce to an assessment of the traditional market that is attempted to be disrupted and how much money is flowing through that market. So, for instance, if an application is attempting to disrupt data storage, Coin, it's worth billions. Amazon, E2C, whatever, so on and so forth, DigitalOcean, it's worth billions. So if they are successful in disrupting that market, it's going to appreciate explosively. Second rule to this fundamental analysis of crypto projects: how likely is it for these traditional markets to be disrupted? That is most important. So there's two reasons for disruption to occur. The technology, one, needs to work. Two, it needs to be financially beneficial. So Amazon has proven itself. Clearly, decentralized and crypto solutions like Coin technologically works. There's complexities. This is mature enough to compete on a feature-to-feature level. And how disruptible is Amazon? So I think that is the appropriate assessment to make. Now, this is where DeFi comes in. So, what has been happening in the traditional market that DeFi is poised to disrupt? It's collapsing. It's destabilized. The yields are meaningless. They are zero. Treasuries, bonds, the risk reward profile, you can't touch this garbage. The solvency event is approaching where companies are not making enough money to pay their dollar denominated debts. They will be going bankrupt. You can't touch the bonds. They will not be paid. You can't touch the equities. They will be going to zero. Hertz is at zero. Their stock is worth zero. Their bonds are worth zero. And these schmucks on Robinhood are buying the crap out of it. They are placing dollars value, unstable value, fiat value, into stock that is worth zero. If Hertz is halted, every single dollar is gone. That's the way it works. So, for the love of God, stay away from equities, or at least have a logical, rational approach to evaluating where value is placed and assigned. So, with regard to DeFi and disrupting the traditional system, one, the technology needs to work. Sure, we have a variety of shortcomings in some of the protocols. We've seen some loss of funds here and there, but the vast majority of the systems are proving themselves and iteratively improving, showing that they technologically work. And they're far superior and offer functionality that traditional financial systems do not. The search for yield in the traditional systems is dead. The search for yield in DeFi systems is exploding with potential. So, what is needed for disruption? One, the technology needs to work. Two, it needs to be profitable. If the search for yield in DeFi systems is exploding and the search for yield in traditional systems is dead, one and two are met. Third premise, how disruptible is the legacy financial system? It's collapsing. It's in the process of an impending solvency event. If thousands upon thousands of companies worldwide are no longer able to service their debt, why won't they be able to service their debt? Because the debts that they created were based on the volume of activity that they had prior to the coronavirus. January, February, last year, 2019. So they're like, oh, we're making a freaking fortune, so let's pile on the debt. Now, what happens after coronavirus? Sure, the volume of activity got destroyed and went to zero, and things are opening up. They will not return to where they were before for years. And the odds are shit is going to shut down again. Either it shuts down because of government shutdowns, or it shuts down because people do not return psychologically to the place that they were before. They have been psychologically disrupted. There is fear. The risk reward profile for normal activities is no longer optimal or entertainable. It is risky to go to social gatherings. It is risky to go to a movie theater. What is the reward? Watching a movie versus getting sick. Fine. Then it gets complicated because most people don't have debilitating and deadly symptoms. But the fact is, myself, I'm probably fine, but I have the potential to infect family members. For me, the risk is not worth it. I'm keeping my technological ass at home. I have no time to get sick. I need to work to support my family. So I do not see a good outcome for the solvency event that is impending. It is going to be historic. So when all of these shitstorms come to reality over the next months, that will highlight the frailty and uselessness of the legacy financial systems. showing that it is entirely disruptible. The technology works, it makes more money, and the legacy system is entirely disruptible. That is the perfect storm for DeFi to shoot off and rocket ship because the legacy system is useless. Anyway, so that's crazy and that's exciting, and this is the place to be. Why would I want 0.5% when I could get 20% in a system that is technologically tantalizing? Synthetics. I am taking value, locking it in their system, generating the functional component of their ecosystem, SUSD, and that makes their system work. And I am providing that SUSD to the market, allowing their platform to grow and evolve. And I'm taking that SUSD, you place that in the curve.fi into their liquidity pool that generates 10 to 20% on that minted SUSD. You take that curve phi pool token, you stake it with synthetics because it is incentivized liquidity, and you get another 23% SNX return on your staked SUSD contribution to the curve phi liquidity pool. For me, I see that as by far the craziest sequence of asset allocation in the DeFi space. Jolo, I am as comfy as it gets. I don't go out. Maybe I get a little loopy at times by not going out, but I have acclimated to this reality. I am prepared for what is going to play out. I have a clear vision of the likelihood of what's going to play out, and that makes me comfy because nothing will surprise me. If I wake up and I see on CNN that tomorrow there's 6,000 infections per day, by the way, there was 3,000 infections per day today in Florida, and I see 6,000, I saw it coming. It's obvious. Isn't it obvious? An exponential growth virus. And then 12,000 and then 15,000, and the government doesn't know what to do because they can't lock it down, because if they lock it down, the financial system literally implodes. So they can't lock it down. And now everyone's afraid to actually do anything. And now all the velocity and all the transaction momentum and people's activity with stores and retail and all the economic components implodes. There's your solvency event. So, asset allocation in DeFi, I described the synthetics component where the synthetics play. What is cool is REN and equity access. So there's something like how many transactions per day of Bitcoin? Where did I put it? I just had it. 343,181 Bitcoins were transacted yesterday. That is a total of $3,227,000,000 worth of value transacted on the Bitcoin network yesterday. That Bitcoin is Bitcoin. That Bitcoin produces no yield. It sits. Sure, folks, these transactions, people are trading in order to increase the quantity of Bitcoin they have, but that's the one-time payoff. The one-time payoff for me is useless. And I hope more and more people see that. To the moon. One time? Shit. No. Stack your value and have your value work for you, producing continuous recurring daily, weekly, monthly revenue. So you could attempt to achieve financial freedom. And guess what? As your value is generating revenue, you take that generated revenue and put it back into your invested value, your saved value, generating more revenue. So instead of trying to accumulate quantities of assets, you're assigning that to generate more and more and more recurring revenue. Warren Buffett does not like gold because it does not produce revenue. So what is gold? Gold is a store of value. It does not produce revenue. And so Warren Buffett is interesting because he's completely not invested in this stock market. He's a fundamental analysis guy through and through. And fundamental analysis is completely dead in the traditional systems. Digital gold can, yes. So there's probably ways to access the equity in gold while still retaining your gold position. I can't think of a goddamn way. If I got a 10 ounces of gold, how do I access the equity of it while still holding the gold? But I can do that with Bitcoin today. I could take my Bitcoin, turn it into REN BTC or WBTC directly, and place that into a MakerDAO CDP and generate DAI. Now, this means I have full control over my Bitcoin. I could access my Bitcoin at any time. Let's say 10 Bitcoin are supplied to the MakerDAO CDP. I could produce safely $30,000 DAI, give or take, with you want about 300-400% collateralization of your MakerDAO CDP to account for substantial value fluctuations, the volatility in the price of Bitcoin. One sec. Not just cases will go up when standard flu season hit. Yeah. When standard flu season hits, many will believe they have COVID-19. In the UK, you have to isolate if you show symptoms. Guys, it's a complete shit show. I've dedicated a couple of videos to the shit show that's going to play out. So you got to be on the defensive, and the best defensive is a great offensive. So understand what's going to play out and position yourself accordingly as best as possible. And that's all you can do. And for me, I'm not going outside. I have no interest in that risk. So MakerDAO CDPs, and you're welcome, Joe. I wish I could do more, talk more. I'll try and find more time. So MakerDAO CDPs, Bitcoin. I have taken 10 Bitcoins and I place it into a MakerDAO CDP, minting 30,000 DAI. I take that 30,000 DAI and I put it directly into a CurveFi DAI, the SUSD liquidity pool, generating 10 to 20% returns at the pool level and 23% SNX returns when the Curve-Fi liquidity pool token is staked with synthetics. So that means I have 10 Bitcoin. I have full control over it because I could liquidate that position, return the debt to the MakerDAO CDP and reclaim access to my Bitcoin. I have full control over it. I am accessing the equity in this Bitcoin that I hold, and so it's leverage, relatively safe leverage if you be smart with your collateralization in the MakerDAO CDP. 300%, please. Be safe. Don't take risk. You don't want to be liquidated. In fact, you want to be so well over collateralized that Bitcoin could drop to $3,000 and you won't be liquidated. Be smart. Don't take risk. Access your equity, generate your return at the pool level, generate your return at the SNX, the synthetics level, and you are now generating recurring revenue by holding Bitcoin. Absolutely incredible. Well, can I make a guide? I think I don't have time for that. I have a lot of work. I apologize, but I'm happy to explain as best as I can in video form. I am always available on Twitter. Ask me questions, and the more people that ask me questions, the more answers I can provide in videos such as this. So the same thing can be done with Ethereum. In fact, Ethereum has better properties for the MakerDAO CDP currently at 0%, so it's a stability fee. So literally it costs 0%. So Consider what MakerDAO is. Think of a home equity loan or line of credit. You want to access the equity in your home. You got closing costs, you got monthly payments, you got all this shit that freaking legacy banks have created for a person to access the equity in their home, compared to MakerDAO, which is zero for Ethereum. Zero, 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 zero. No closing costs, no monthly payments, no nothing. Access to your equity. Now, are we seeing why the legacy system is poised to be disrupted fundamentally, profoundly? It seems pathetic in comparison. Jolo, I'd rather do it for free because I simply don't have the time. I'm on YouTube. I'm here. Ask questions on Twitter. I will answer anything in YouTube format. So WBTC is accepted on MakerDAO. Ethereum is accepted on MakerDAO. Kyber Network is likely going to be accepted on MakerDAO. Everything's going to be accepted on MakerDAO. Anything that is reasonable, that is a sustainable project that has longevity, it will provide in 1, 2, 3, 4 years the capacity to access equity in whatever asset you can imagine. Why not? There's no logical reason why not. Back to Digibyte. Talking Digibyte. So we're talking about disruption. Crypto in general is a talk about disruption. BiDAO? No, 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 no. I don't. I'm not interested in Binance projects at all. They're not interesting at all. I wouldn't get involved with them or pay much attention to them at all. Just being honest. Ethereum and the amount of corporations that are involved with Ethereum warrant the attention. That is what the corporate world is building on. They're building a replacement financial system. So, okay, you were talking. So, Joe mentioned Digibyte. So, what system is being disrupted with regard to Digibyte? It's record storage and asset management. Now, the way I see it is that type of adoption is going to take much longer because the status quo is much more difficult to disrupt. That is a more entrenched infrastructure. Corporations, technologies, data centers, it's very difficult to disrupt. But what's pertinent with regard to UTXO projects is critical mass decentralization, which means it's not going anywhere. It has all the time in the world to be there when the systems want to be exploited. We want the corporations and the governments to exploit Digibyte for its properties, for its data storage and asset management capabilities. Now, there's all UTXO projects have the same characteristics: data storage and asset management. So what I see playing out at some point is, I myself am a developer. As developers, we look for toolkits. So what will be the case? There'll be a toolkit available for access to a basket of UTXO projects for purposes of data storage and asset management. And Digibyte falls in there. I don't know about Litecoin, but the point is, okay, Litecoin falls in there. The whole point is, as a developer, I have a library that has access to not 1,000, 20 critical mass decentralized projects that have eternity to live. And depending on the properties of the UTXO chain, the developers at a company can choose one chain to base their software development on. A basket of UTXO projects that developers could choose which chain to consume depending on the properties of the chain that best suit the project that they're trying to build. And that's where Digibyte fits in. Now, Digibyte is warp speed. It's brilliant. It might be the best in the basket of UTXO chains to consume. A proof of stake coin might be better for another project. So this is the evaluation that developers will do when they have their library that gives access to a basket of UTXO chains when they're deciding which chain to consume in their project. Any DeFi projects on your radar under 100 million market cap? Not under 100 million, but you're talking Kyber Network. Obviously, Bancor just had a pretty bad marketing experience with a vulnerability in their contract. So here, let's talk about the liquidity pools. Let's talk about Kyber Network, Bancor, 0x. There's a bunch more. Balancer Labs, but you can't really. So I'm not a fan of this liquidity mining for governance tokens, and this whole MegaDAO compound thing is. I don't know how it's going to play out because all the volume on compound is Tether. I don't know. It's something doesn't feel right. Trust your gut when you're looking at these projects. That compound token could collapse. What's supporting it? The only thing that's, when you're talking about a speculative asset, the only thing that supports it is supply and demand. So it could collapse if the demand triples. This is what I want to get into. The supply for compounds is not going to decrease. It's getting emitted. It's increasing. So here we go. Kyber Network. There's a certain quantity of tokens out there. It's a deflationary. It has deflationary properties. Every transaction on the Kyber Network, Kyber KNC, is burned. That is the most important component of an asset experiencing appreciation, deflationary properties. Now, the protocol upgrade that Kyber Network is going to go through really soon, sooner than later, is, to me, some of the best thought out protocol properties to encourage appreciation of their asset. Brilliant. Incentivized volume, where people that provide, organizations that provide liquidity, the big ones, they get rewards. So they're incentivized to market and encourage integration of the protocol to drive volume. So there's your demand and supply. There's a burn component as well as a reward component for people that hold KNC to stake. So the burn component decreases supply, and the reward component encourages staking, which locks up supply. So you have the not monetize, but you have the component that encourages demand, and you have the components, plural, that are reducing supply. That is a recipe for massive price appreciation for Kyber Network tokens. 0x, brilliant protocol. It's frankly, that's one of the second projects that I've gone in and out of many times, and I just that comes back to like portfolio balance, and I don't want to spread too thin. The only thing that turns me off about 0x is that it's not a deflationary protocol. 0x tokens are not burned. So there's no deflationary component. But you can stake to get rewards, which are transaction fees. So, I think there's great merit to the project, and I think it will have longevity. Bancor, recent events aside, Bancor, is their V3 protocol, is touting the solution to impermanent losses, which is crazy. Impermanent losses are when, let's say I hold ETH and MakerDAO. So the pool is constantly going back and forth as people are trading back and forth. So if all of a sudden people want to acquire a lot of Maker, that means they're putting ETH into the system and Maker's coming out. So the pool becomes imbalanced. So what happens if Maker explodes in price? The component of the pool that you own is mostly ETH, and Maker is much smaller, but Maker has gone up 100, 200% in value, you have lost value. Those are called impermanent losses. I don't know how Bancor is proposing entirely to resolve that. I think there's a component that they have that balances the pool somehow, maybe automated arbitrage. But I find that interesting. So their new V3 protocol is going to be inflationary with the initial inflation set at 0%. That is my turnoff. I don't like inflationary projects. So technically, does it? So Menachin North, I got it. Staking 0x decreases the available supply. Okay. I see your point. There's no burn component. There's no total supply reduction, but there is the staking component locks up supply, which takes it out of circulating rotation. Okay. That's a good point. Way to add something to the list of pros about the protocol. Very nice. Okay, that's great merit. I've been in and out of 0x several times, so way to give me another reason to think about wanting to be a FOMO. I'm not going to FOMO. If I get into it, I'm spread too thin. I need the velocity on the projects that I think are stronger. Focus on a small basket of projects that you think are strongest and consistent with your investment thesis. Because if you spread too thin, you're not going to get the velocity of appreciation that you want. So portfolio balance. I've talked about this in videos. Anyway, so KNC, 0x, Bancor. For me, it's Kyber. That's just my 2 cents. I briefly looked over. James says I've been looking into iExec the last few days. 4 PhDs, some strong partners. Yes, I've read and heard about this. Crypto Chico talks about it. Chico Crypto talks about this quite often, or has mentioned it many times. What's the market cap? CoinGecko. Let's take a look real quick at the market cap for iExec. iExec 127 and 38 million with 4 million traded per day, max supply of 87 million, 70 million in circulation. Okay. Well, those very broad properties of the project are quite interesting. I think based on that, it warrants a good peek. Roll back to what's most important. How disruptable is the status quo industry that is attempted to be disrupted? How likely is it to be disrupted? And how much revenue can iExec capture from that potentially disrupted industry? That's how we look at projects, ladies and gentlemen. Anyway, so James, low token supply, you're right. So it warrants due diligence, but don't spread too thin. Portfolio balance. All right. Is it Menace North? Not Menace. So Ren, you mentioned Ren. I talk about Ren all the time. In fact, I spoke about it in this video. I think Ren may be the most important project in the crypto space right now that could unlock $175 billion worth of equity and throw it into all the lending and DeFi projects, which would change the entire appeal of crypto for all the participants of the legacy financial system that are slowly really realizing the legacy financial system sucks. And they're like, how do we get yield? And then they'll see all this incredible lending and borrowing and awesome DeFi technology and be like, oh, there's a lovely source of yield there. And this is what's happening. This is where we are. Decentralized cloud computing, is there a market for that? That's Ethereum. It's Turing complete. It's a computer. Sure, there's if we break 1,300 sats, I say buy more Ren today. Oh, well, I don't know. we've been in it for way below 1,000 sats. So there's risk reward. Listen, if you think it's going to change everything, accumulate. But don't accumulate thinking it's going to go higher. Accumulate because you want to generate recurring revenue with a dark node. And that's the holy grail. It's yield. You need yield. You want yield. That is how you get financial freedom, is yield. Returns on your assets, not just appreciating asset prices. What will happen to Bitcoin maximalist minds when there's more Bitcoin circulate? I don't know. Listen, side chains. I want side chains on Bitcoin. I want side chains on Ethereum. I'd rather Ethereum 2.0 not be released. Keep the network the way it is. Throw in gas tokens, Chi gas token, GST2. Reduce those gas fees. Side chain the crap out of it. ZK roll up. Leave it the way it is. Don't mess with a system that is working. Build on a system that is working. Throw on those side chains to scale the transactions per second, to resolve the gas fee issue. And I think that is a better way to scale. Digibyte is not going to implement POS to the best of my knowledge. I don't want to see any protocol upgrades to Digibyte. I think Digibyte is timeless. I think it should remain exactly the way it is. They have to do nothing with regard to the protocol, in my opinion. And I think it is inevitable that, as I said, it will be part of a basket of UTXO projects that developers in the future will choose to consume when they're building their projects. And Digibyte is the best. But depending on the project, some protocol properties of other consensus mechanisms, so on and so forth, might be more beneficial. And that is the point of the basket of projects that develop, basket of UTXO chains that developers can choose from. The best thing about REN is that the yield is paid in the collateral asset, not in REN. Sure, it's awesome. That's brilliant. Longs and the team's design of the system, the due diligence, the auditing process, the way this project has been implemented, it is poised for something incredible. Interoperability is everything, ladies and gentlemen. It is the barrier, the end-all barrier for impediments to growth. Once it breaks down, this thing is going to be unleashed. The equity of UTXO thrown into lending protocols where the lending generates returns for lenders. That's what banks do. DeFi allows you to do what a bank does in a riskless fashion. How about that? So when a bank lends money, they ask for 5%, 10%, 20% on a mortgage. If the person doesn't pay, the bank is screwed. Over collateralized lending systems ask for 150% of the loan. It's not, it achieves the same thing, but the lender has almost no risk. How about that? How about that? DeFi has fixed the greed problem with fractional reserve banking. The pathetic legacy system has been fixed by nerds with computers that could do it. How about that? Absolutely incredible. Let's look at some comments. I think ETH 1.0 will continue to exist. I have no idea how that's going to play out. I don't hope for a fork. Forks aren't good, and that's why I think we should stay on ETH 1.0 and not risk a chain split. Any price prediction on DGB? No price prediction on GGB. Hold DGB. You hold it. Hold what you're comfortable with, and don't forget about that you have it, because I think that it has timeless. It is timeless. It's not going anywhere. So either just hold it. Don't buy too much, then feel uncomfortable. Always remember this with regard to investing. The whole never invest what you can't afford to lose mentality. If I have $1,000 and it goes to zero, I know how much I lost. But if that $1,000 turns into $100,000, those are the bets that change your life. If the $1,000 goes to zero, guess what? You're getting up and going to work tomorrow either way, and you lost $1,000. To me, that means jack shit. Oh, I didn't get to buy a TV, a new TV, so I have to live with the TV that's currently sitting in my living room. Move your money into the asset that could change your life instead of getting the stupid TV that's sitting that you want to put in the living room. I blew your mind, my man. I can't do that. I've already done that. How could one's mind that is blown be further blown? We have similar opportunities. Yes. No, it's not similar. It is what the banks do, except a non-pathetic version. Fractional reserve banking is pathetic. DeFi, I put my money into Compound, Aave, or the liquidity pools. Curve Fi, which has almost no impermanent losses, which is the holy grail of liquidity pools. Each asset has the same value. There's no impermanent losses in Curve Fi. And you are generating yield based on the liquidity pools because of transaction fees, but on the lending, Aave and Compound, because of lending. You are doing what a bank does, but the person borrowing is over collateralized, so your contributed lending, what you are contributing to the lending, isn't at risk. If the borrower doesn't pay back, or the collateralization of the loan is under collateralized, they're liquidated, ensuring that the lender's contributed value is preserved. It's a almost riskless lending process, while also giving people the capacity to access equity in their assets. So let's say you contribute, someone has $1 million worth of DAI, and they put it into Aave, and they're paying like 6% interest per year. Well, maybe DAI isn't the best example because it's a stable coin, but let's say they have ETH. They put $1 million worth of ETH into Aave, and they're paying whatever the interest rate is. They have their $1 million worth of ETH. They're paying 6%, let's say, but now they have $30,000 worth of DAI that they could go on and exchange and trade or invest or do something with. So they have that value, which is the goal is to generate more than the interest payment on the equity that they're using as collateral to borrow off of. And that's how this works. That's banking. This is banking. This is the fundamentals of the legacy financial system, but done non-pathetically. The end of the Rothschild dynasty, control over money creation in time. I mean, look, we're disrupting the legacy financial system, and that's not going to be easy. But the technology works, it's better, and the legacy system is poised for disruption. So we've met the three criteria that I very much think is the three criteria for some shit to go down. Surely there is no way back now, even if government. Yes, this is not stoppable because it's the internet. If Kyber Network as a company is shut down by the government, their smart contracts are still alive. If Uniswap as an organization is shut down, their smart contracts are alive. They still function and work. They are not shut downable. Period. This cannot be stopped. It is immutable. So consider that. 18 to 24 months. Oh goodness, 18 to 24 months is a lovely time frame. No one knows me anything. I like to talk. My wife says I like to talk, James. Let's build a better world. We're warriors of the next. I'm so tired and angry at the legacy system. I'm tired of working. I want to do what I want to do when I want to do it, which is work. but on my terms. And that's what's so frustrating with the legacy system. It's not on my terms. It's on someone else's timeline, some organization. Let's build a better. He's in the chain of progress. We're all adding to it. Where we inform people of the space, the more chance of real adoption. Yes, adoption. It's going to happen. There are a couple of things that concern me a lot about DeFi today. Much of it is way less decentralized than I like. The attack vectors, yes. So here's the thing about decentralization on Ethereum. So the problem is smart contracts have a private key associated with their deployment, so the developers can upgrade them. This can be decentralized, the control, and this is exactly what RenVM does, and this is where it's heading. The access and control, the governance of these smart contracts can be done in a decentralized fashion by smart contracts. RenVM is a decentralized custodian of private keys. Mix these technologies together, you could have a decentralized custodian of the private keys that are used to manage the deployment of smart contracts. And you layer the governance token on top with your automated smart contract voting regimen, and now you have decentralized management of smart contracts. So yes, you're right, and it's concerning, but you got to remember all these organizations producing these DeFi projects have a vested interest, and not just a monetary vested interest. They want to change the world. This is the people standing up because the system is so broken and they want to make it better. So I think there's honor, a lot of honor in a lot of these projects. Teller, tempting. It's an oracle. I have mixed feelings about oracles. Focus on recurring revenue. Sure, if you're going to own Teller, you want to mine. So Teller is mining, and I think there's a minimum Teller you need is probably I think it's almost $15,000 worth of Teller, and then you need GPU hardware to mine. So if you're going to buy Teller for the Teller to appreciate, that's not a recurring revenue stream. While you're doing it, don't do it. You want recurring revenue streams. Focus on recurring revenue streams. So if the capacity to participate with Teller with regard to mining and recurring revenue is not in your financial capacity, I wouldn't get involved with it. Now, Link is cool. Link is $1.3 billion market cap, but you could create a node and you can generate revenue and returns. So I wouldn't, Link can appreciate. I mean, it could go up, but it's not going to pull 100x. It's not going to be worth more than Ethereum in the short term. Sure, many people think that may be the case, but I wouldn't bank on it. The risk reward profile is not worth it to me. And I don't want appreciation. Oh, fine, appreciation is going to be nice, and it's the basis for holding Bitcoin currently. But I want the recurring revenue streams. I don't want the appreciation. Anyway, any thoughts? The problem is smart contracts are built by people. Yes, true. But there will be there'll be a critical threshold that's a consistency with these smart contract implementations that establishes theming, where if the smart contract is crafted like this, it has ultimate stability and reliability. And I think we're getting there, where the bugs are being worked out and they're going to be relatively secure. They're overwhelmingly functional because look at these platforms and systems that we're using. They're functional to work. I have a couple more minutes. Celsius Network has come up with a great lending, and yes, Celsius is a centralized crypto lending platform. Celsius and BlockFi, cool. They do the same thing. They take in and they issue over collateralized loans. There's nothing wrong with that. I like the notion that I am in control over my funds at any given time merely by executing an Ethereum transaction, interacting with a smart contract, albeit you have access to your funds in a relatively reasonable amount of time with BlockFi and Celsius, where you can pretty much extract your money promptly. So it's all about a custodian, whether the custodian is centralized or decentralized. There's nothing wrong with BlockFi and Celsius. I think they'll be an integral component of future systems, centralized and decentralized financial systems. But the new paradigm, not the legacy, pathetic fractional reserve banking system. Uh, uh, of course, I invest to make money, but I only invest in things that put the world I want to live in forward. Sure, my man. Well, it's not investing, it's saving. You're transferring value from one asset to another, and you're accumulating assets. You are saving because you're not saving money. Fiat as money is dead. You need to save assets. You're not investing, you're saving. Once the smart contracts are proven, they should be rendered well, they should be updatable, but I would say in a decentralized fashion where there's a governance mechanism controlling decentralized control over the private keys that affect the updating that or offer the capacity to upgrade deployed contracts. I think that could be decentralized. I don't see why not. Michael Burgess was speaking in a podcast today about how we hopes REN can act essentially as a currency exchange. Well, yes, interoperability. So the central bank, we can't get into this, so it's going to take too much time, but the central banks, guys, the system is crumbling. The central banks need to issue CBDCs, central bank digital currencies, now. Paper dollars are done. There is not enough. There's a quadrillion dollars of debt. They can't get the dollars to where it's needed. It's not practical, not possible. They're in an emergency situation. I'm sure behind closed doors, they're saying we need to get digital currencies out immediately because then they could issue whatever they want, wherever they want, and however much quantity they want. And they could satisfy the requirements for maintaining the whatever crazy concoction the central banks are thinking of. They need to distribute money instantly, and that's what the CBDCs will facilitate. I think that at some point we'll see an emergency release or a prompt release of the U.S. CBDC, but it's not going to be the government that issues it. Brian, the OCC, Brian Brooks. Brian Brooks was the dude at Coinbase that crafted USDC, and he is the person in charge of the US OCC, Office of the Comptroller, the highest position in America responsible for money. The comptroller of the currency is the person who created Coinbase's USDC legal framework. He's brilliant. He talks a lot. If you Google Brian Brooks, you will find him speaking in YouTube videos or whatever. So and they're 2 inches away from an appeal in a New York court where the US OCC is appealing New York, preventing the US OCC from issuing fintech banking charters. Brian Brooks wants to issue fintech banking charters to Coinbase, Gemini, and others. If they get a fintech banking charter, the U.S. Treasury could directly collateralize USDC and GUSD. And instantaneously, the United States has CBDCs, collateralized US dollar denominated stablecoins. Think about that for a second. They're 2 inches away from this shit. James, back to work. Yes. Anyway, my man. I'm not getting into Libra, guys. I'm going to wrap it up. I got to get back to work myself. Hit me up. No. I'm not getting into war in Menace North. Hit me up on Twitter. Ask me questions. Let's keep it rolling. And I'm going to make some more videos and we keep on talking. Thank you for everyone joining me today. It's always a pleasure to speak and talk. It's a curse or a blessing, depending on how you look at it. But it's always a pleasure. So I will catch you next time. Cheers, everybody.